Hey everybody, I hope everyone is doing well and had a good day. In today's video, we're going to review the E-mini S&P 500 5-minute chart for Wednesday, August 5th, 2026. Daily chart, I've been talking about the trading range here for a lot of bars, but if we zoom out, actually if you look at the weekly chart, it's even more clear. Market's in a bull trend. Here's a rally. Here's simply a two-legged pullback and then a bull breakout trend resumption. So when we look at the daily chart, it's the same pattern, but just more bars. So tight bull channel and then trading range, This is a pullback in the bull trend. And you don't know if this is going to lead to a reversal or continuation. It's a trading range. It's probably close to 50-50. Maybe probability slightly favors the bulls because the trend is up going into this trading range. And then here we had here's what the information we had going into the day. The bulls see a bull trend, a double bottom, bull flag, a higher low, and then trend resumption with especially strong bars yesterday and the day before. So Monday and Tuesday this week. Going into the day, what's the expectation? It's clearly always in long. The market's going up strongly. There's probably buyers above yesterday's high. Traders are buying above bars, buying the close of bars. There's gaps between the close of the prior bar and the open of the next bar. There's a gap up from the close of the prior day and the open of the next day. So probably going higher here. And even if a trader buys the close of yesterday, the odds are they'll be able to, if they're willing to scale in, use a wide stop and scale in, they're probably going to make money. Any reversal is more likely to be minor, so it's unlikely that the market goes from a strong bull breakout like this immediately into a strong bear trend. And then here's the 5-minute chart for today. We had a gap up going into the day. I'm just drawing yesterday's high. Gap up into the day, which is similar to the past couple of days. There's been a gap up followed by a bull trend from the open. But there's a difference between those past 2 days and today. Just briefly, we'll look at them. We can see here, gap up, far above yesterday's high, bull trend bar, another trend bar, couple bars sideways, and then continuing up higher. Next day, pretty similar. Gap up, far above all the bars to the left, trend bar, couple trading range bars, and then a couple more trend bars. So clearly going higher. But today was different. We still had a gap up going into the day, but look at the first bar. It's a trading range bar. Next bar, a trading range bar, heavily overlapping the prior bar. The next bar, an inside bar, another trading range bar. So this is different. This time we're getting a trading range on the open, the first 3 bars going sideways. So it looks like it's a limit order market. You can expect sellers above these bars and buyers below the lows of the bars. Bear breakout bar 4, but probably it's a strong looking bar, but probably buyers below bar 1. And then a strong reversal bar 5. We tried to break out below the bars to the left. The bear breakout failed, and then the market reversed back into the range. But now we're in the middle of the trading range. So to buy above bar 5, we may go a little higher, but there's probably sellers up at the top of the range. Bar 6, strong bull breakout bar, but at the top of the trading range. Just imagine any trader, if you were buying, it's another gap up. You see a bull micro channel, higher lows. Maybe a trader buys here on bars 1, 2, or 3, and they're trapped by the bear breakout on 4 and further trapped by bar 5. And that's disappointing. If you're buying up here, now you're holding a losing position. So what is a trader going to do if the market comes back to their original entry? The trader who bought up here is probably going to be disappointed and look to sell. So bar 6, as strong as bar 6 is, It's a great looking bull breakout bar closing on its high. It's not breaking out above all the bars to the left. So the risk with bar 6 is that it's a vacuum. It's a buy vacuum just testing resistance, and there might be more sellers above bar 6. In this case, we did not even trade above 6 of the prior bars. We just immediately sold off from the open of the next bar. 7, not even an upper tail on the next bar. Traders were eager to sell the close of bar 6. It looks like there's even a tick gap, meaning the open of bar 7 is below the close of bar 6. So it looks like the market is going sideways here in a trading range. Traders are buying low and selling high. 7, bad stop order buy, probably sellers above the bar, but also probably buyers below the bar. It's near support. Inside bar 8, so continuing to go sideways here in this limit order market. Expect sellers above, buyers below. Same with bar 9. Consecutive inside bars, II pattern, but it's occurring in a trading range where we already know the market's going sideways. We already know it's breakout mode. You can expect sellers above and buyers below. Although the buyers may not come in below these bars, they may wait to buy down here or even down here. Could be the bar 7 low or the bar 5 low, or the moving average also probably support. A bear breakout bar 10, but a lot of overlap with the prior bars. I said there might be support anywhere, any of these levels. Traders are buying here. We tried to break out below and failed, reversed back up. Tried to break out here, failed, reversed up. So bar 10, even though it's a bear breakout bar, it's forcing you, if you're selling, it's forcing you to sell sort of in the middle of the tight trading range. So instead of selling here, better to sell closer to resistance. And instead of buying here, better to buy closer to support. So in this case, bar 11, it broke out below the prior bar, but it's a failed bear breakout. Big tail below the bar, testing support. The bar 7 low in the moving average. So what about buying above bar 11? It's the same problem as buying or selling below bar 10. Forcing you to sell. Bar 10 was forcing you to sell in the middle of a trading range, which is not ideal. You want to buy low and sell high. Bar 11, reversal bar, forcing you to buy. The stop order buy is forcing you to buy in the middle of the range. Not ideal. Better to sell high and buy low. So there might be buyers below bar 11 and probably sellers above the bar. And then 12 went outside down, strong bear breakout bar. At this point, over the past few bars, the market is going down. We're still in a trading range, but we have a low, a lower low, we have lower highs. So it's possible that the market is channeling down here. And the buying pressure since bar 6 has been weak. So a couple of inside doji bars here, reversal bar, but very small body. But bar 12 is at support. So not ideal for selling bar 12, but maybe traders will sell a pullback. Why is bar 12 at support? I said it's testing the moving average, and there's a bear channel line. So bears might be taking profits here at support. 13, the bear bar 12 gets a follow-through bar. Not a very strong bar. It's a trading range bar. But 13 is a weak, low probability stop order buy. Double bottom 5 and 13. But if you're buying above 13, stop below 13, you know you're taking a trade with good risk reward. So you might buy above 13 and you stand to gain 2 times your risk. If you buy above the bar, stop below the bar, and you look to exit at the top of the range. However, whenever you have a good risk reward profile, you very likely have low probability because there's no perfect trade. You have to think that every trade you take, there's an institution, there's a profitable institution taking the opposite side of the trade. So I think it's wrong thinking to believe that you're ever going to take high probability trades with good risk reward. There's always going to be a trade-off. So if you have good risk reward, then guess what? The other trader taking the opposite side of the trade has the high probability, which means you have low probability. So all that is to say, yes, it's a double bottom with bar 13, 5, and 13, but the double bottom is low probability. Better for the bulls to wait for maybe a micro double bottom, a second entry long, because 12 and 13, I said it's a fairly tight channel with weak buying pressure since bar 7. So we may need a trendline break first, and then maybe a second entry long before the bulls buy. And then we continue down here, 14, 3-bar micro channel. You can see the bear channel is developing, and now that we have a 3-bar micro channel, it's a bad stop order buy. 14, 12 through 14 will probably get a second leg down, which means any reversal attempt will probably be minor and lead to resumption down. A doji bar 15, a 4th bar added to the micro channel. Trading range bar, expect sellers above, also pretty decent momentum for the bears. So any reversal attempt is probably going to be a pullback that leads to a second leg down. 16, a decent bull breakout bar, but fairly small bar, maybe an average size bar, but it's a single breakout bar after the tight bear channel. It's also almost completely below the moving average, and if you're buying here, the market is forcing you to buy at resistance. We just broke below the moving average, and now we're testing the moving average. So it was expected that the moving average would be support, and it was on bar 11. We bounced. But then on bar 12, anyone buying at the moving average here got trapped by the bear breakout 14. So when the market comes back and tests that area, those traders who bought the moving average trapped here, they may be disappointed. They may be looking to sell out of longs with bar 16. And I said, if you just look at most charts, anytime there's a micro channel, consecutive bars with, in this case, lower highs, most of the time there's a pullback and a second leg in the direction of the micro channel. So here's a micro channel, doji bar 15, weak stop order buy. We have a pullback. We trigger the buy above 15 on 16, but it's not likely to reverse the market in a big way. More likely, the micro channel will get a second leg down. Then we get a second leg down on 17. This was a measured move, target reached. If you use the high of bar 12 to the close of 14, and then take that measurement to the top of the pullback, you can see it's very close, slight overshoot of that leg 1 equals leg 2 measured move target. Fairly big tail on the bar, also you might call it leg 3. 1, pullback, 2, pullback, 3 legs down, but the channel down is still tight. The buying pressure is weak. So as far as buying here, I would not. If anything, to buy, you might be buying back shorts because we're testing a channel line. We're also testing the gap up. So from yesterday's close and the gap up into today, there's a breakout point. The market's testing that area. So it makes sense to buy back shorts here. But to go long, I would not. There's not enough buying pressure. Before buying to go long, it's better to wait for a trendline break of the tight channel, then a retest of the lows, and then maybe you can get a major trend reversal or a trading range. Inside bar 18, trading range bar testing breakout points, 15 low, 16 low, probably sellers above 18. 17 will probably get a second leg down. Also, it's a tight channel, so from maybe 7 to 17, it's a breakout on a higher time frame. You can expect the breakout on the higher time frame to pull back and then get a second leg down. Another trading range bar 19, probably sellers above, expecting a second leg down. We found buyers below bar 19 on 20. The market tried to break below the bar, but failed. This is actually a 3-bar micro channel, 17, 18, 19, 3-bar micro channel for the bulls. Traders buy below the bar, but they're probably scalping. The bulls know if they're buying that the odds of a major reversal here it's a low probability event. We're also testing near the bear trend line. So bar 20, it's a weak stop order buy. It's two legs. If you're buying above 20, two legs against a tight channel. And it's also testing near resistance, breakout points, moving average, bear trend line. So probably sellers above bar 20. 21, outside down, bear, breakout, low 2 short, low 1, low 2. Selling below 21 for a stop order scalp is a high probability trade. High probability that we test at least a little bit lower, probably get below bar 17. The buying pressure is still weak. For the bulls, it's hard to make an argument for buying here. The bulls might buy below 17, betting that breakout points the market is overlapping breakout points, but as far as buying here, I would not. And then 22 breaks far below the breakout point, the bar 17, swing low, but then there's a huge tail, 22. Different computers draw channel lines different ways. I have this one drawn. This is one way to draw a channel line. There's also one here, and there's probably other ways, maybe using bar 1. There's several different ways. What's important is to see there's at least one or two ways to draw a channel line, and bar 22 is testing that channel line, and bear channel lines act as support. So reasonable location for taking profits on shorts. But again, for buying here, buying to go long, really not ideal. Not a lot of buying pressure. The channel down is tight. The buying pressure is weak, so we're probably going more sideways to down. Inside bar, and then a breakout bar 24. Now it's another 4-bar bear micro channel. Expect sellers above the bars and a second leg down, which we get here. Sellers above 24 on 25. We go sideways for a couple of bars. 27 is a bad stop or buy. Expect sellers above. Expect the micro channel to get a second leg down. Trend resumption 28. Reasonable stop order sell. You can sell the close 29. Just another micro channel. Sell the close, sell above. Expecting at least a second leg down. Micro channel continuing here, 30, reasonable sell. But once again, testing near a channel line. So if you're selling here, you know you're selling near support, the bear channel line. It's a late leg in a channel far below the moving average. So if the market starts to go sideways, it's reasonable to take profits and look to sell a pullback instead. You can sell far below the moving average in a late leg if there's sustained momentum, but if the bears start to lose that control, then your premise becomes invalid. Bull reversal bar 31. The context, so 3 legs down on a channel line far below the moving average. Reason enough to exit shorts above 31. 31 not a high probability buy, but reason enough to take profits on shorts because there's a chance that the channel corrects for a couple of legs and we pull back here. But for the bulls, better to wait for a second entry long. Micro channel continuing down here, but there might be buyers below 31. Breaking below the swing low, 22 low. So we broke below 31, but then failed to get a follow-through bar. Broke below 30, failed to get a follow-through bar, 31. Maybe buyers below 31 on 32. There's a tail below the bar. The bar closed above the low of the prior bar, but a bad stop order buy. Probably sellers above this bar, 32. 33, a micro double bottom, down, up, and same idea as 31. Reason enough on 33, bull reversal bar. There's enough reason to expect a pullback here. Late leg near the channel line, far below the moving average. Okay to exit shorts above 33, but buying above 33, it's a low probability trade, but offers good risk reward. 34, a trading range bar. Now we've gone sideways for 4 or 5 bars in this late leg, far below the moving average. I said you can sell far below the EMA in a late leg if the bears have momentum. But now that we've gone sideways for 3, 4, 5 bars, bears are losing that control. So 34, there might be more traders buying below 34. And 35, a bull breakout bar, but closing below the high of the prior bar. So this is a weak bull breakout, but it's breaking the bear trend line and it's testing resistance. This was a trading range, tight trading range back here, bear flag. We broke below it. This is resistance. The bar 28 high in this area is resistance, but then also the moving average is right there as well. So the market reacts to that resistance, but 3-bar micro channel, probably buyers below 35. The bulls will probably get a second leg sideways to up. Now the bulls have done their minimum objective, breaking a bear trend line. Now the expectation is a test of the lows, and then maybe the bulls can get a major reversal. But at this point, the bull breakout looks weak, and it's more likely to go sideways than straight up. Also, as far as the bigger picture, context, and day structure or day type, very strong bull trend over the past couple of days. It would be unusual to get a strong bear trend all day today. We have had a tight bear channel for almost half the day, but more likely this is going to end up going more sideways or even reverse back up. So some kind of trading range following this tight bear channel, trading range or bull reversal, is more likely than a bear trend that lasts all day. And that's based on the higher time frame context, but also looking at the bars on this day. When you look at small pullback bear trend days that last all day, they don't really look like this. And you can see, I mean, it's a little different comparing a bull trend to a bear trend, but the point I'm trying to make is that this looks like sell climax, pause, sell climax, pause, sell climax, pause, sell climax. What I'm trying to say is the price action is not behaving the way it does on small pullback bear trend days, as far as the way the bars look, because technically you are getting small pullback trending behavior as far as pullbacks lasting 1, 2, or 3 bars and pullbacks being shallow, but it's these big bars like 17 and 22. You just don't get these kind of bars on small pullback trend days that last all day long. Small pullback bear trend day, it's basically the opposite of this. Sustained buying the whole time, none of the bars being very climactic. Same here, just kind of grinding its way up, small pullbacks along the way, but no huge bars with big tails breaking above channel lines. You just don't really get that. The point is the selling does not appear to be as sustainable as it could be. So the expectation here is more of a trading range or a reversal, but not a small pullback trend day all day long. $36, a strong bull breakout bar, but on the lower time frame it's leg 3, so 3 legs up in a channel on the smaller time frame, breaking above a bull channel line. It's attempting to break out above the moving average, the first test of the moving average in about 20 bars. It's also testing that resistance from back here. So as strong as bar 36 looks, the context is not very good. It might be the top of a trading range. And it fails to get a follow-through bar. The bulls do have a micro channel. It'll probably get a second leg up, probably buyers below 37, but 37 is a bad stop order buy. It's probably sellers above the bar, sellers above 38. For 39, it's still a micro channel, 33 to 39. There might be more buyers below 39. Bulls looking for that second leg up. The bears get a second leg down. This is all minor. Maybe it's even 3 legs down, 37, 38, and 40. Probably sellers above 40 and buyers below 40. 41, strong bull breakout bar in this tight trading range and testing resistance. So good looking bar, but bad context, kind of like 36. There might be more sellers above. 42, double top with 37. Bulls might exit below that bar. There's risk that the tight channel, it's a breakout on a higher time frame. This is a pullback, and then a second entry short could lead to trend resumption, especially 43 becoming a bigger bar, bigger bear body, closing near its low. Reasonable stop order sell below the bar. There is strong enough buying here, though, that the downside here might be limited, and then we've gone sideways for about 8 bars, so this might be a limit order market with buyers in this area below bar 37 at the low of 36. Breakout minimum follow through bar 44, but it's a trading range bar near support. There might be more buyers below the bar. Bad stop order buy, so middle of the trading range, bad stop order buy above the bar, might be sellers above 43, may get a second leg down. 45 a doji, but to buy above 45 would be buying near the top of the range, probably sellers above and buyers below, and this limit order market continues for a lot of bars. 47 an okay stop order buy, but still forcing you to buy near the middle of the tight trading range. It's not ideal. 48 for the bears might be at least leg 3 near support. There's probably buyers below 48. 49 bull reversal bar, good looking signal bar, but forcing you to buy near resistance. 49 may get a second leg up, but maybe better to buy a pullback. Small spiking channel structure on the lower time frame, that's 3 legs up to resistance, probably sellers above 51. As far as selling below 51, you have enough bullish momentum. There might be buyers below 51 for a second leg, which the bulls get. This is a very small structure, so you get that on the very next bar. 52 pulls back and is that second leg up. Now 52 is at resistance, probably sellers above. Second entry short 51 and 53, double top, a reasonable sell below 53. But if you sell 53, small bar, the stop does not go above 53. You have to think about that. Does it make sense to sell below 53 and put your stop loss above 53? Which is basically saying if I sell below 53, but if the market goes above my signal bar, then the short position is no longer valid. The premise is invalid. But that doesn't make sense because the high of the bar is at resistance. So if anything, it makes more sense to sell more above the bar, or maybe don't even sell below 53, but sell a pullback, wait to sell above the bar. So the stop loss here does not make sense. If you're selling 53, the stop probably goes at least a measured move up based on the size of the signal bar up here. But I think 53 is a reasonable stop order sell below the bar. 54, bears get a reversal and follow through, but a small trading range bar in the middle of the range, probably sellers above and buyers below. Buyers may come in down here. 55, bull breakout bar, but a late leg, attempting to break out of this limit order market. So a lot of trading range price action. 55, testing the high of the trading range. I said late leg, at least leg 3, maybe leg 4. So 55, strong looking bull breakout bar, but it might be a sell to close bar because it's forcing traders to buy near resistance in a late leg in a trading range. Bulls failed to break out above the trading range. A trading range entry bar, 56, probably sell to close and sell above the bar. 57, an inside bar, maybe okay to sell below the bar, but because it's a trading range bar and an inside bar, better if you can sell above the bar. 58, bull reversal bar, but again, it's this late leg in this bull channel near resistance. There's probably more sellers above 58. Inside bar, 59, probably sellers above. As far as buying below, the buyers probably don't come in until later, lower in the range. We trigger the buy above the bar, but it's a bad stop order buy. And you can see what happened. 60 broke above the bar and then closed below the high of the bar. The breakout failed. Probably sellers above 60. Bad signal bar to sell below 60, but the context is okay. Many legs up near resistance in a trading range. 61 bear breakout bar, But look where it's testing. You look to the left, and there's this invisible line. I have this red horizontal line drawn here. Every time the market tries to break below, it fails. Tries to break below, it fails. Tries to break below, it reverses up. 61 is testing that price once again. What's going to happen? It's probably going to fail to break out and reverse up. And we reverse up here with a bull micro channel, 62, 63, 64. But look to the left, and we're testing resistance. There's a breakout point, bar 60 low. The high of bar 61 is resistance. So bull micro channel, yes, decent momentum. But look to the left, you're at resistance. So not a great area for buying. If anything, there's probably more sellers up here. 64 does not get a follow-through bar, but at resistance, we get a bear bar. For the bears, maybe better to wait for a second entry short because of the momentum. The bulls might buy the first pullback for a second leg. There's probably sellers above 65. In this case, 66 broke down, and bar 61 got a second leg. But 66 approaching support, there's probably buyers below 66. And then 67, bull reversal bar near support. Reasonable stop order buy, looking for a second leg sideways to up. But because it's such a tight trading range, it's a limit order market. Better if you can enter with limit orders, because to buy above 67, it's forcing you to buy in the middle of the range. It's better if you can buy low and sell high. And the 68 is testing resistance. Buy the closed bulls. Just take it back a few bars. Anybody who bought the closed 64, trapped and disappointed by the bear breakout 66. When the market gets back here, there's probably trapped traders selling out of longs. So if you buy above 67, your profit potential, it's not great. The upside is limited. So there's probably sellers above here, sellers above 69. Bulls get a couple legs up, but still testing resistance. Upside probably limited. Doji bar, probably sellers above. As far as buyers below, not a great location. Buyers are going to buy closer to support. 72, bears have a double top after 2, maybe 3 legs up on the lower time frame. Reasonable stop order sell below 72. 73, bear breakout, probably get a second leg down. 3 bar micro channel, enough momentum that the first reversal up will probably fail, but selling here near support, you need momentum. The bears have momentum. They're expected to get a second leg down, but we might bounce here at support. Sellers, more likely sellers above 74, micro channel, usually sellers above and a second leg down. So the bulls looking for a second entry long to 75, not a great stop order buy because of the momentum. There's trapped traders. We're testing a breakout point. Anybody who bought below 71, trapped on 73, 74. So the low of 71 is a resistance area along with the moving average. So expect a second leg down. Bears get that second leg in just 1 bar, 76. Now we're back in breakout mode. We might break below the range, or the bulls might get, on the lower time frame, it's a second entry long, down, up, down, up. But again, stop order buy above 76, not ideal. Middle of the range, might be more sellers above. Doji bar, 77, probably sellers above the bar, and then probably buyers below the bar. Traders are buying near support. And then a huge breakout bar, 78, obviously breaking out far below all the bars to the left, but look further back. And this is probably going to act as support, because anybody who was selling back here, if you sold bar 70, or if you sold bar 32, 33, you're trapped by the bull reversal. So when the market gets back to your original entry, if you sold the close, or if you were the unlucky bear who sold the low tick of 32 or 33, when the market gets back here, you're probably going to take profits. You're disappointed by the rally and the trading range. So 78 is a great looking bar, but most of the bar is within these bars to the left. Let's see, can the bears get a follow-through bar, or are there trapped traders here buying back shorts? And 79, it's a much smaller bar than 78, but there is a reaction at that support. And instead of getting a follow-through bar, the market we got a bull breakout bar, or it's a bull trend bar, it's inside bar. 79, a bull breakout bar, but heavily overlapping the prior bar. I suspect 78 is strong enough to expect a second leg down, because there's the trapped traders. Anybody who was buying near this support, they were making money during this trading range, but then we broke far below that range. So anybody buying here gets trapped by 78, and that is probably going to lead to a second leg down. The problem for the bears is this support that I talked about back here. So the pullback can be deep. We might go back and test this breakout point. And then bar 80, a bull breakout bar. So big down, big up, probably sellers at the breakout point to the left. And we're out of time here. For stop order entries today, pretty difficult on the open. Especially after 3 dojis on the open, you're expecting a limit order market. So buyers below bars, sellers above bars. So like buying above 5, not ideal. Selling below 10, not ideal. Maybe selling below 10 is okay, because the bottom, there's room to support in this range. Stop order through here, difficult until the tight bear channel really becomes established. I thought for me, the best stop order sell through here was probably bar 21. Bar 28 was also reasonable. I said you can exit shorts above 33, but buying above 33 to go long, it's a low probability trade. Stop orders through here, I thought 43 was a reasonable sell. 47, an okay buy. Let's see, through here, this is all very tight trading range behavior, so stop orders not ideal. Maybe buying 67 is okay, looking for a second leg up, but the upside's really limited. 72, selling below 72 was reasonable. Double top, triple top, near resistance with plenty of room to the bottom of the range. That's probably it for stop orders. For limit orders, trading range on the open, so sellers above and buyers below is reasonable. Buyers below 1, sellers above 3, which didn't trigger. Sellers above 7 did not trigger. Sellers above 11 was reasonable. Sellers above 15, reasonable. Sellers above 18, 19, 20. Sellers above 24. And let's see, probably buyers below these bars, but they never triggered. So taking the first limit order buy was reasonable. Bull micro channel, first pullback fails to reverse the trend, and the bulls get a second leg. So buyers below 39 is okay. But selling here, so the rally to 36 pulls back. Anybody who bought here disappointed. So selling above 41, selling above 42, that's reasonable. And then this is all limit order market trading range behavior. Buying below 40, buying below 46, buying below 48. Near the top of the range, selling above 52, selling above 53, reasonable. 55, a good looking bull trend bar, but late leg at resistance, selling the close, selling above, reasonable. Maybe a limit order buy at the close of 61, trend bar, but then a micro channel against, and then when the market comes back and tests near support, there's a location to buy there. Maybe okay to sell 69, above 69. The bulls have 2 legs, second leg sideways to up near resistance, selling above 70, 71, 72, but those ones did not trigger. Selling above 74 was okay. And that's about it. All right, that's going to be it for today's end of day review. Thanks everybody for watching. And for more price action fundamentals and how to trade price action, please visit the brookstradingcourse.com. There's a link in the description of this video. Once again, thanks everybody for watching, and I hope everybody has a good night.